Chapter 20. Why corporate loan systems look complex, business complexity versus IT simplicity. Corporate loan management systems are often perceived as inherently complex, a perception that stems from a fundamental tension between the intricate demands of business operations and the pursuit of streamlined, efficient IT solutions. This chapter delves into the multifaceted reasons behind this complexity, exploring both the business drivers and the challenges in translating these into manageable technological frameworks. Understanding business complexity in corporate lending. Corporate lending is not a monolithic process. It encompasses a vast array of financial products, regulatory requirements, risk assessments, and client-specific customizations. The inherent complexity arises from several key areas. First, diverse loan products and structures. Banks offer a wide spectrum of corporate loan products, each with unique characteristics. Term loans with fixed or floating interest rates, various repayment schedules, and covenants. Revolving credit facilities with flexible borrowing limits, drawdowns, and repayments, often tied to collateral. Syndicated loans involving multiple lenders participating in a single loan, requiring complex intercreditor agreements and agency functions. Trade finance including letters of credit, guarantees, and other instruments supporting international trade, involving multiple parties and jurisdictions. And project finance for large-scale, long-term financing for infrastructure or industrial projects, with intricate risk-sharing arrangements. Each product demands specific workflows, documentation, pricing models, and lifecycle management, contributing significantly to the overall system complexity. Second, the regulatory and compliance landscape. Corporate lending operates within a heavily regulated environment. Compliance with regulations such as Basel III, Dodd-Frank, CECL, IFRS 9, and local banking laws is paramount. These regulations dictate capital requirements, risk reporting, anti-money laundering, and know-your-customer checks, and data privacy protection. Changes in regulations necessitate constant updates and adaptations to loan systems, adding layers of complexity to their design and maintenance. Third, risk management and credit assessment. Effective risk management is at the core of corporate lending. This involves credit underwriting, portfolio management, stress testing, and early warning systems. The integration of various risk models and data sources into a cohesive system is a major challenge. Fourth, customization and client-specific needs. Corporate clients often require tailored loan agreements, pricing structures, and reporting. This demand for flexibility means that systems cannot be entirely rigid. They must accommodate a degree of customization without compromising scalability or maintainability. The pursuit of IT simplicity and its challenges. While business operations are inherently complex, IT departments strive for simplicity, standardization, and efficiency. This often leads to a disconnect. Legacy systems and technical debt pose significant challenges. Many financial institutions rely on legacy systems built over decades. These systems, while robust, are often monolithic, fragmented across multiple systems, and built on outdated technology stacks. Migrating from or integrating with these legacy systems introduces significant IT complexity. Data integration and consistency is another major challenge. Corporate loan data is vast and originates from various sources: core banking systems, CRM, risk engines, collateral management systems, and external data providers. Ensuring data consistency, accuracy, and a single source of truth across these disparate systems is a monumental task. User experience and workflow design must support complex loan processes while remaining intuitive. Users require systems that support their specific workflows, provide relevant information at each stage, and minimize manual intervention. A poor user experience can lead to errors, reduced productivity, and resistance to adoption. Scalability and performance requirements grow with corporate loan portfolios. Systems must scale to handle increasing transaction volumes, data storage, and computational demands while maintaining data integrity and security. Bridging the gap. Strategies for managing complexity. Effectively managing the complexity of corporate loan systems requires a strategic approach that aligns business needs with IT capabilities. Modular architecture and microservices break down monolithic systems into smaller, independent services. Each service can handle a specific business function and be developed, deployed, and scaled independently. This approach enhances flexibility, reduces interdependencies, and allows for faster innovation. Robust data governance and master data management are crucial for ensuring data quality and consistency. This involves defining data ownership, standards, and processes for data creation, maintenance, and usage across the organization. Business process management and workflow automation can significantly reduce manual effort and improve efficiency. Automating routine tasks allows human experts to focus on complex decision-making and client relationship management. Agile development and iterative delivery allow for continuous feedback from business stakeholders. This helps in breaking down large, complex requirements into smaller, manageable user stories. An API-first integration strategy facilitates seamless integration with internal and external systems. Well-defined APIs enable different components to communicate effectively, reducing data silos and fostering a more interconnected ecosystem. Practical implementation notes and best practices. Start with a clear business glossary to ensure a shared understanding between business and IT. Prioritize critical functionalities to deliver value incrementally. Invest in strong testing, including unit, integration, and user acceptance testing. Foster collaboration between business users, IT developers, and risk managers. Embrace cloud-native solutions for scalability, resilience, and access to modern development tools. And implement security by design to protect sensitive financial data. Conclusion: the perceived complexity of corporate loan systems is a direct reflection of the inherent intricacies of corporate lending itself. While IT strives for simplicity, it must effectively encapsulate and manage this business complexity. By adopting modern architectural patterns, robust data strategies, agile development practices, and fostering strong business IT collaboration, financial institutions can build and maintain corporate loan management systems that are both powerful and manageable, ultimately supporting efficient and compliant lending operations.